Welcome to The Explainer. Today, we're digging into a bold prediction that has Wall Street absolutely buzzing. Could gold really be on a path to $5,000 an ounce? Yeah, that's a headline that'll make you do a double take, right? But this isn't just hype. Some of the biggest names in finance are actually predicting that gold could hit this massive milestone in just a couple of years. So in this explainer, we're going to play detective. We'll break down the forecasts from the big banks, uncover the powerful forces that could be driving this rally, and of course, examine the risks you absolutely need to be aware of. Okay, let's dive right in by looking at our expert witnesses. I'm talking about the major banks and top analysts who are putting their reputations on the line with these calls. First up, we've got JP Morgan. And get this, they're not just saying gold will hit $5,000, they're forecasting that as the average price in late 2026, and they're even hinting it could push all the way up toward 5,400. Bank of America is right there with them, seeing prices hitting that same level. And they add a bit of a wild card in what they call debasement-driven scenarios. Think high inflation, a weaker currency. They see a real possibility of gold hitting $6,000 an ounce. And it doesn't even stop there. Some really respected independent analysts are even more bullish. You've got Ed Yardeni calling for 6,000 by the end of 2026, and honestly, some are looking at even higher numbers as we get closer to the end of the decade. What's really striking when you lay it all out like this is the broad consensus. Sure, the exact numbers are a little different, from Morgan Stanley's 4,800 all the way up to JP Morgan's 5,055, but the direction is crystal clear. Everybody is pointing up. So that leads to the crucial question, right? Why? What's the motive behind this potentially massive move? Why is practically everyone so bullish on gold right now? Well, the first batch of clues points to a huge shift in the global order. Central banks, especially in places like China and Russia, are buying up gold at a record pace. It's all part of this bigger strategy called de-dollarization, where they're trying to rely less on the US dollar. And on top of that, with all the uncertainty in the world, investors are scrambling for safe havens. And a lot of them are expected to pour money back into those gold-backed funds, the ETFs. Someone described it as a powerful cocktail for higher prices, and you can really see why. But the economic drivers, that's only half the story. Let's look at the financial factors that could make the case for gold even stronger. And this is where the financial side of things really comes into focus. As the Federal Reserve starts looking at cutting interest rates, holding an asset like gold, which doesn't pay any interest, suddenly becomes way more attractive. You add in growing government debt, a weaker dollar, an inflation that just won't go away, and gold starts to look like a pretty critical insurance policy. So beyond the why, our investigation also turned up a pretty fascinating pattern about the when. It begs the question, is there a secret season for gold? Well, it turns out there just might be. The phenomenon is known as the January effect. And what it means is that historically, gold has shown this really strong, consistent seasonal performance right at the start of the year, especially in January. And the data is pretty compelling. Look at this chart. Since 1971, the average return for gold in January has been nearly 3 times its long-term monthly average. That is a huge historical edge. But, and this is a really big but, we all know that past performance is not a guarantee of future results. Seasonality is just a tendency. The fact that we saw negative returns in January of 2021 and 2022 is a sharp reminder that this pattern definitely doesn't always hold true. Okay. No good investigation is one-sided. We have to look at the counter-argument. What could possibly stop gold from reaching that $5,000 target? What could derail the whole thing? You can see it's basically a giant game of tug-of-war. On one side, you have all those tailwinds we've been talking about, but on the other, you've got some powerful headwinds. A more hawkish Federal Reserve, meaning they keep interest rates high, or a suddenly stronger US dollar, or even a surprise de-escalation of global conflicts. Any of those things could stop gold's rally dead in its track. And there are other risks too. It's kind of ironic, but if prices shoot up too fast, it could actually scare buyers away. That's a concept called demand destruction. And of course, if central banks don't cut rates as much as everyone expects, or if investors suddenly get brave and shift back to riskier growth stocks, the rally could cool off in a hurry. So we've reviewed the forecasts, we've looked at the drivers, we've considered the roadblocks. After all that, what's the final takeaway from our investigation? What's the verdict?
Well, at the end of the day, it looks like this. There is a strong, multifaceted case being built here. This isn't based on just one thing, but on a powerful combination of central bank strategy, investor demand for a safe haven, and these really big long-term money and government spending trends.
The path to $5,000 an ounce seems to be paved with some pretty strong fundamental arguments. But as our investigation has shown, there are also some significant roadblocks that could pop up along the way. So the final question is really for you. With all the evidence in, is $5,000 gold an inevitable destination, or is it a speculative dream? The journey to find out is certainly going to be one to watch.